Hello students, this is a short video on demand and supply and marginal benefit, marginal cost. This is actually the same curve, but the demand line can be labeled marginal benefit and the supply line marginal cost. Is just two different ways of looking at it. So let's get started and you'll understand what I mean. If we think about the market for shoes, I'm going to draw what's called a demand line. And what the demand line is going to tell us is how many pairs of shoes you might want to buy in a year at different prices. So on this axis I have price, on this axis I have quantity, and this is an individual demand curve. So let's say shoes sell for $100. You may want to buy 5 pair of shoes in a year. Let's say they sell for $50. You may want to buy 10. So, assuming this matches you, or this we'll just call this person A, what we have here is we have a line that connects the different quantities of pairs of shoes this person would buy at different prices. I put 2 points on it, 5 at 100 and 50, and $50 would be 10. So this is intuitively obvious to most students that if things cost more, you'll buy less. In economics, we call it the law of demand, and we say that price and quantity demanded are inversely related. Inversely meaning they go in the opposite way. One goes down, the other goes up. Now, if we drew a graph that wasn't just an individual's curve, but the curve for the entire market, and we can define market pretty much however we want. It could be the whole city, or the whole state, or the whole country, or the whole world. But we know that if we're adding the individual demand curves, how much each individual would buy at every price, we're obviously going to have more when we add them all together. So let's say that here, in this market, make the market a town, at $100 we'll sell 5,000 shoes a year, and at $50 we'll sell 10,000. So that's pretty much all there is to a demand curve. It simply gives us the relationship between price and quantity demanded. But we could ask the question of why the demand curve is positioned the way it is. What could change it? And there's a lot of things that could change it. If you get more income, if a certain type of shoe becomes more popular, if there's more population, a lot of different things could change a demand curve. And so I will increase the demand curve here. I'll call it D1. And I'm going to increase it such that now, if shoes cost $100 in this town, they would be willing to buy, oops, it's not supposed to be a dollar sign. They would be willing to buy 10,000 pair. If they cost $50, they would now be willing to buy 15,000 pair. So if we look at what this is telling us, I want you to notice that if we go along this first curve and we are willing to purchase more shoes, that would be because the price fell. From $100 down to $50, we're willing to purchase 10,000. If they fell from 50 down to say 25, we're willing to purchase 15,000. But that's because the price fell. When we shift the demand curve, we're willing to buy more at every price. So again, maybe we have more income in our town, maybe there's higher population, all kinds of things. In your principles class, if you took it, you learned that all kinds of categories of things that could shift the curve, but we don't care about that here. We just need to understand that if the curve shifts, it means that our purchasing behavior at every price changes. It could shift out and it could shift in. So that's the demand. Let's add the supply here. Because no matter how much we want to purchase, if nobody's willing to sell them to us, we won't buy them, will we? So we can have a supply curve on an individual demand. We can have a supply curve on a market demand. We'll work with the supply curve on the market demand here. And the supply is basically all the firms that are selling shoes. Kind of a combination of the manufacturers and the distributors. And just like the demand curve tells us how much we are willing to purchase at every price, the supply curve tells us how much the firms are willing to sell at every price. And this is telling us that if they're $50, they can sell them for $50. They're willing to sell 10,000. If they could get $100, it looks like they'd be willing to sell 15,000. If they're only $25, it looks like they're willing to sell maybe 6,000. What determines how much they're willing to supply at every price? It's actually their costs. And it's their costs, meaning the cost of leather, the cost of labor, the cost of electricity, just all their costs. And there's also a calculation of something in there called opportunity costs, which has to do with how much they could make if they sold something else. So you can see that if they are going to make more, they are willing to sell more, and their costs definitely go up. But also, if there was something else they were planning to make instead of shoes, they would be less likely to do it the more they can get for shoes. So the law of supply tells us that price and quantity supplied are directly related. In other words, they move in the same direction. Now, what's interesting here is the supply curve by itself won't tell us the price of shoes. It just tells us how much a firm is willing to offer at every given price, just like the demand curve won't tell us. Not by itself, but when you put the two on the same graph like I have, we have this point here where they cross. And I'll get rid of my other demand curve now. Wasn't much of an eraser, was it? So we have this point here where they cross. And we call that point the equilibrium point. And at the equilibrium point, there's no pressure for the price of the shoes to go up or for the price of the shoes to go down. If the shoes were selling for $100, you can see that these manufacturers and sellers would have a lot more on the shelf than people wanted, because the quantity supplied would be 15,000 and the quantity demanded over 5,000. So they would likely put them on sale. It would drive the price down. Opposite, if the price was $25, you could see that the quantity supplied is 6,000 and the quantity demanded is 15,000. So you could easily, if you're a shoe manufacturer, start raising the price and putting a few more on the shelf both. So we tend towards the equilibrium point here. We tend towards the equilibrium point here. I want to also note that you saw earlier when I shifted the entire demand curve out, we could also shift the entire supply curve to the left or to the right. And if we do that, what it's telling us is that we're willing to supply a different amount at every price. Again, if we shift the whole curve, it's because we're willing to supply a different amount at every given price. If we supply a different amount because the price changes, we're along the same curve. So we've got our equilibrium price and quantity here, and I think it ended up being 50 and 10,000 or something like that. And And we're calling this supply, we're calling this demand. There's another way to look at this. We've got our equilibrium point. There's another way to look at this. And to do that, I want to define a term called marginal. Marginal is used a lot in economics, and it means incremental. So for example, if you are out jogging and you're trying to decide whether to jog one more mile, that's an incremental decision. Then after you jog that mile, you might decide whether to jog another mile. That's an incremental decision. You might decide whether to buy one more candy bar. Incremental decision. And one way to look at these curves is that this demand and supply curve, is that the decisions about them are incremental. So let's do it with the demand. And I'm going to change the name of the demand here to marginal benefit. Same curve, talking about the exact same thing. We've got R. But you know, it might be easier if we go back to the individual demand curve to explain this, where we were going to buy 10 pair of shoes if they were $50. Now, if price fell to $40, let's draw another point here, it looks like we would be willing to buy 11 pair of shoes. So the question is, why would I pay $50 for the 10th pair of shoes and only $40 for the 11th pair? Well, that would be because my marginal or incremental benefit of an 11th pair of shoes is only $40. My marginal benefit of a 12th pair of shoes is only $30. So at any given price, what I'm finding out here is the benefit to me of one additional pair of shoes. That's what that price is telling us. So again, we're looking at it from two different angles. And we could call this either the demand curve or the marginal benefit curve. We have the same thing with the supply curve. At $30, I'm willing to supply, as a supplier, so let's say we're willing to supply 8 pair of shoes. At $40, we're willing to supply 9. And in terms of marginal, what would cause this? That would be the marginal cost. The extra cost associated with selling one more pair of shoes would allow me to sell it for $40. Now, in environmental economics, we're going to work some with the terms supply and demand, but a lot more with marginal terms. Marginal cost and marginal benefit are the most common terms associated with a demand and supply for a product, but we're actually going to be talking about demand and supply, marginal cost, marginal benefits for things like pollution. So we're going to be adding other terms, marginal abatement, marginal damages, things like that. But this is the basics of how a supply and demand curve are constructed. It's the basics of how we turn a supply and demand curve into marginal curves. And I'll be happy to answer more questions as you have them. Just contact me.